11 sentences from a 7-figure quant trader that changed my trading forever. I'm Minir, also known as Coastal Trades, and I also run unbiased trading. Let's get straight into this. First is focus on a portfolio of strategies, not a single strategy will save you. Don't rely on a single strategy. Build a portfolio of uncorrelated or weakly correlated algorithmic models, or you can even do manual execution if you prefer, or if you're having challenges going with the algorithmic side of things. However, I will obviously say, if you're doing manual execution, it's going to be a lot harder, maybe biases come in, things like that, etc. And what this will allow you to do is mitigate risk and capture a broader range of market inefficiencies. Now, this is obviously a well-known concept from Jim Simons. Ray Dalio says something different with assets, but it's the same kind of thing that applies to strategies. And this was a key unlock that he told me that really helped. It's really common for us when especially you get into trading that you think one strategy is going to be the holy grail. Now, I can say sometimes that will happen. I've known a couple of people that have found an arbitrage, for example, that's worked for a couple months or maybe a month, and they've made significant amount of money with that. Now, that is definitely the more rarer case. I'd say for a lot of people, building the portfolio strategies is a better method to go after, and that's personally what I'm going after. That doesn't mean you can't look into arbitrages as well. It just, don't rely on just trying to find one arbitrage that's going to make you a ton of money. Two is strategy parameters should fight to survive. Do not add parameters that don't make a measurable difference. Strategy parameters should be data-driven and statistically significant. Avoid overfitting by limiting those that don't drastically improve performance metrics. I often see a lot of people add a lot of parameters because they think, hey, this thing, adds a small bit of extra edge to it. That doesn't really actually make sense. The more parameters you're adding to a strategy, the more likely it will be overfitted. So if you're adding another parameter for just maybe a 1 or 2% boost in, profits or something like that, for the most part, that's never going to really be worth it. The key ones I'm normally looking for is if I'm adding a parameter, if it's really reducing my drawdown, or if it's significantly increasing my profits because the selectivity of that parameter really helps the strategy. Those are normally the two ones I'm really looking at. So just try and stay away from just adding needless kind of parameters on top just because you think it may help a small bit. And also, I guess one step before that is you really should know how much a how much a parameter is helping a strategy. Don't just kind of slap them on without having any data behind it. Three is your strategy will stop working at some point. Don't grow attached. It won't feel anything when it loses you money. Now, detachment is essential, especially with algorithmic strategies, and I guess in trading in general. Strategies will degrade over time due to market shifts, and maybe they'll start working again in 2 years or something like that, or sometimes they will completely fade away and there will no longer be that edge. Now, you need to maintain objectivity and be prepared to adapt, or you have to just be ready to abandon these underperforming models. And for the most part, I'd actually say you don't need to fully abandon them. Just put them in occupation. So put them in a sim environment or something like that once they've started not performing very well. And then at some point, maybe in the future, they will start working again. Now, obviously, that's no one really knows if they will. But sometimes when you're dealing with strategies that are very market dependent, so like if it's really dependent on a really good, strong bullish market, then those will obviously work terribly during a bearish market, but will pop up again and work really well in a bullish one. So there's different parts of it of how you detach and be able to be fine with letting a strategy go. But at the end of the day, if you're treating trading as a business, you just have to get rid of some of these revenue streams if they're not working anymore, and that's kind of how I look at it. For algorithmic trading is not hands-free. Set up monitoring and risk management techniques in preparation for any potential disasters. Proactive risk management is key in trading. Algorithmic trading obviously requires constant vigilance, and a lot of people get into algorithmic trading, think they will be able to run something and never look at it again, and it's just taking all the perfect trades and no issues. Now you can obviously deploy an algorithmic trading strategy and have less time on the screens than you would with a manual strategy. But you're still going to need really good risk controls in place. Make sure you have them set up with a broker. Make sure you have alerts set up. Make sure you know when a trade is on, when it's looking for a trade. Things like that can really help with that risk management side of things. And don't get into algorithmic trading thinking it's going to completely mean you can sit on the beach all day and they'll be able to still take trades. Don't get me wrong, in the perfect setup you maybe can, but that isn't the common, and there's a lot of hard work that goes into it to even get to somewhere like that. 5, curiosity is the biggest edge. I personally love this saying by him, and it was really a big thing for me to hear because curiosity really drives edge. You need to never stop learning and exploring new techniques, approaches, new ways other traders are trading. And a curious mind is essential for identifying and exploiting new market inefficiencies. And as we already previously stated, there's going to be strategies that are going to decay or stop working. So you're constantly in a grind to find new strategies as they come. And this curiosity is the biggest one of it, especially when you're starting out. Be curious about anything you hear, test it, check it out, maybe apply with some other thing you learned before. Those things were pivotal in me actually becoming more successful as a trader. 6, it's never about the next trade, but about the next 100 or 1,000. Think long term. Focus on cumulative performance over a large number of trades. Avoid the temptation of short term optimization that could actually jeopardize your long term profitability. So many times I hear people refer to just the previous trade being a bad trade, and that really shouldn't matter. If you've obviously made a mistake with that previous trade, if you're doing manual execution, for example, then yeah, that does matter and you need to look at it and find ways to improve upon it and things like that. But if you're just saying that, oh, the last trade was a loss and now I want to implement these new things to prevent that loss in the future, the only caveat to that is if it's a catastrophic loss. If there was something you did not know and that was a huge risk that, happened on your previous trade, then yeah, implement a new thing to maybe protect you against it. But if it's just a normal loss and you're trying to implement something new to stop that kind of loss happening, you're just destroying the actual strategy itself. So be really careful about that, and that's also known as like recency bias. 7, the most powerful parameters are those that detect the type of conditions for the strategy type. Now, optimizing for strategy fit is really important. The most impactful parameters are those that effectively identify the market conditions most conducive to the specific strategy success. So in this example, let's say a mean reversion strategy, those are going to work best in choppy times of high volatility, or it doesn't actually have to be super high volatility, but normally that is the best kind of circumstances. Whereas trend works amazingly when there is a consistent direction happening over time. That can necessarily maybe be high volatility, depends on the kind of trend strategy. But you'd normally, in an ideal world, you just want a line that's going up, and you're just taking trades as it kind of like goes up. So looking for that and finding parameters that help you find those conditions are the ones that are going to cause the biggest impact on your actual strategy. Now, the caveat to that is those are the hardest ones to actually find. That's probably why they create such a big kind of improvement to your strategy. So look around, test new things, but be careful with this as well. You're inherently looking on a hindsight bias kind of part of this. So be careful with these. These can be really easy to overfit. But if you're trying it in a correct kind of backtesting manner and then forward testing as well, these can be the best ones to implement. 8, if I could change one thing, I wish I had deployed more strategies in occupation. You never truly know until you try it out on live markets. Now, live market testing is crucial. Backtesting is vital, and this whole channel is about backtesting and quant trading, algorithmic trading. But real world testing is also vital for actually seeing if a strategy can work. On a backtest, potentially, it doesn't show the most amazing, most best performance, for example, but until you deploy it live for maybe 1-3 months, you'll never really know actually how effective it is. So obviously you want to take the backtesting side of things serious, but then you want to deploy as many of these strategies you develop into just inoccupation, which is just a sim account or even really small amount of money, and just see how it goes. There's no downside to that. Obviously, maybe you have to pay for a server or something like that, so maybe there's a small upfront cost, but deploying those are so important because you'll never know, maybe in a year the market conditions shift and that new strategy you developed 5-6 months ago is working amazingly and now you can activate it. So those things are really important, and it's a really small thing and a big tip he provided for me. 9, sample size is king. Don't make changes based on small occurrences unless it affects risk management. Now, sample size matters as the key thing in trading, as you want big sample size for it to be statistically significant. And now you want to avoid making data-driven decisions based on limited observations. Ensure a statistically significant sample size before modifying strategies. The only caveat here is for risk management. So, for example, if there was one trade that could have or did cause a huge loss for you, then that is something where you do want to just instantly kind of change whatever you need to in the strategy to avoid that in the future. Now, those are those catastrophic events. Those are things that maybe are unforeseen, things like that. Those are good to add and adjust on a strategy, even when the sample size is 1, because all you need is one of those cases to happen and you could blow up the whole strategy or your account, for example. So that's the only caveat. For everything else, like improving performance, trying to get rid of a normal loss, things like that, do not do that unless you have a big sample size. 10. A strategy is only as good as your discipline to follow it. This applies even in algorithmic trading. I have lost the most money due to changing my strategy when it was live before ample testing. Discipline is paramount. Now, most of the time, people will be telling you discipline of sticking to your trades, things like that, and using it as a cover word for pretty much everything in trading. There's a lot that goes into trading. I personally believe it's a lot more edge focused, but obviously psychology does come into it and does matter. But even in algorithmic trading, where people advertise it as, hey, there's no emotions, nothing like that, you need to be able to adhere to your predefined strategy. If you are changing that strategy every month, every week, for whatever reason, you're not actually keeping to that strategy and testing that strategy. You're just modifying it and making it untestable because you can never do a proper comparison to your backtests. So avoid emotional overrides and maintain that discipline to follow your established trading strategy. And this obviously applies when you're doing it manually and even algorithmically. The only difference is algorithmically it's on a higher time frame. So you're changing it based on a week of performance, where manually you'll maybe change it because the trade looks a bit different when you're executing. So just two different ways of looking at it. 11. Don't try a one-size-fits-all approach. Markets trade differently from one another, and it's extremely rare to find one that works on multiple. This is a myth that I discovered earlier on, is that you would think, hey, if I could find a good strategy that works on 10 different markets, that'd be incredible. That's what I want. That is so rare. It's insane. I've tested at least 300, 400 strategies, and I've only maybe found a couple that works on a couple similar markets. And the only reason they work on those is because they're very similar in price action, volatility, things like that. You're rarely going to find something that works on, let's go extreme, like works on BTC and then works on RTY. That's going to be incredibly rare. And if you find it, feel free to send it over my way. But it's very rare. So don't think your strategy needs to work on tons of different markets for it to be a good strategy. It can just work on one market. And then, a similar test you can do is apply it to maybe similar markets with similar characteristics and see if it, works decently well as well. And that's can be a good sign as well for your strategy. Thank you for watching. If you enjoyed it, please like it and share it with anyone else who might be interested.